You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 12th of February 2024, and I'm joined by my co-host, John McEwen. In this week's episode, we'll be discussing Diageo, Airtel Africa, Novo Nordisk, GlaxoSmithKline, AG Barr, and our US company of the week is PayPal. John, do you want to start us off with a favourite of the show and member of the fantasy portfolio, Diageo?
Yeah, I do, Sam. So the group had their half-year results out last week with reported half-year net sales of $11 billion, which were down 0.6% on an organic basis. This decline was largely driven by a 23% fall in its Latin America and Caribbean region, where customers have been consuming less and down trading to cheaper alternatives. Trading remained positive across the group's other key regions, largely as a result of price hikes. Operating profit came in 5.4% lower at $3.3 billion, driven by a decline in the LAC region, so the Latin America and Caribbean region, which is one of the group's higher margin markets. Free cash flow improved from $964 million to $1.5 billion due to improved cash generation from operations. And net debt rose from $17.8 billion to $20 billion. In the second half, Diageo expects organic net sales and operating profit growth to improve compared with the first half. Medium-term guidance has been maintained, with organic net sales and operating profits both expected to grow in the region of between 5 and 7%. The group declared an interim dividend, which was increased by 5%, and they've got share buybacks totaling $500 million, which are also to be completed in the first half. And the shares were down about 3% following these results. In terms of valuation, Diageo has a market cap of £65 billion and trades at 18 times forward earnings, compared with a 10-year average of 21.3, with a prospective dividend of nearly 3%. I think these results were slightly disappointing, but they were broadly in line with what we expected after that profit warning in November, with the sales in Latin America and the Caribbean dropping 23%. But still, the group's expecting growth of between 5 and 7% in the region, and trading across the other main regions has been decent, and the group being able to hike the prices by 7.3% last year with only modest drops in volumes, I think is a testament to the brands. It's got some fantastic brands in there. I know we've mentioned them previously, but they are from Guinness, Smirnoff Vodka, Baileys, Gordon's Gin, Tanqueray, Captain Morgan, Don Julio Tequila, and a number of others as well. So they are some of the best brands, or the strongest brands in spirits. And then when it comes to, I guess, stout, Guinness being up there. And they've had, I think, fairly smart acquisition strategy, particularly getting onto the tequila growth in recent years. Valuation-wise, as we've seen compared with the 10-year average, it is certainly down, reflected in these recent results. But I think if you were buying it as a long-term proposition, I think it's quality growth brand, and compared with Brown-Forman, it's a lot more affordable for what I would argue is a better portfolio. So I'd buy this and, happily sleep at night and expect, a long-term quality compounder here.
I would agree. I mean, it's cheaper than the last couple of times we've looked at it, partly because I don't think the share price has been too forgiving to the recent results. Because I can't remember ever seeing, in the time we've covered it on the show, the chance to get it for 18 times earnings. It's normally been around sort of 25 to 30. I think at 18 times earnings in this market, I think it's very, very reasonable. I know these results are a bit lackluster, but we've been covering this on the show for 3 years now. It's pretty consistently put up very, very good results, apart from maybe the last 6 months. I think it does deserve a bit of slack. So to be able to go in and buy it at the price Unilever usually trades at, which is a company that has been dealing with various issues for a number of years now and not been putting up the kind of numbers that Diageo has consistently, I think in the market we're in, if you've got a little bit of patience, I think it's very, very reasonably valued.
Would you take a nibble?
I wouldn't know, but I prefer things that I can lose more money on than Diageo.
Okay. Fine. All right. Well, that's lead on
Speaking
to
of
the next
which.
company. Yeah, speaking of which, exactly. Company that operates with its main market in Nigeria.
Yes, so Airtel Africa, another favourite of the show and member of the fantasy portfolio, have come out with their Q3 results. And for anyone who's not familiar, Airtel Africa is a telecoms provider that provides data, voice, and mobile money services to about 14 African countries. They have come out with their Q3 results, and customer base grew by 9.1% to 151.2 million. The penetration of mobile data and mobile money services continued to rise, driving a 22.4% increase in data customers to 62.7 million and a 19.5% increase in mobile money customers to 37.5 million. Constant currency average revenue per user growth was 10%. That was primarily driven by usage across all segments. Mobile money transaction value increased by 41.3% in constant currency, with Q3 2024 annualized transaction value of $116 billion in reported currency, and all these figures are in dollars. Revenue in constant currency grew by 20.2%, with Q3 2024 growth accelerating to 21%. Reported currency revenues declined by 1.4% to $3.86 billion. And in Q3 2024, reported currency revenues declined by 8.3% as currency devaluation, primarily the Nigerian naira devaluation, continued to impact reported revenue trends. All segments continued to deliver double-digit constant currency growth. Across the group mobile segments, revenue grew by 18.6% in constant currency, driven by voice revenue growth of 11.2% and data revenue growth of 28.5%. Mobile money revenue grew by 31.8% in constant currency. Constant currency EBITDA grew by 21.9%, and the margin was 49.4%. Profit after tax was $2 million in the period, primarily impacted by significant foreign exchange headwinds, particularly the $330 million exceptional loss after tax following the devaluation of the Nigerian naira in June 2023, and the Malawian kwacha in November 2023 after the structural changes in their respective FX markets. The Nigerian naira devalued further in Q3 2024, resulting in $140 million derivative and foreign exchange loss net of tax, which is not treated as an exceptional item. I do think the first time this happened, they put it through as an exceptional item, and I think that was fairly all right because it was anticipated to be a one-off. It has now happened again, so I do completely agree with the treatment of no longer treating it as exceptional. It is just part of the results and something that unfortunately may just be an ongoing issue. Earnings per share before exceptional items was 7.1 cents, a decline of 34.6%. Basic earnings per share was a negative 1.6 cents, and that compares to a 12.5 cent earning per share in the prior period, impacted by the significant derivative and foreign exchange losses. Capital expenditure was $494 million, and that was 8.2% up to the prior period. Capital expenditure guidance for the full year remains at between $800 and $825 million. Leverage of 1.3x in December 2023 was improved from 1.4x in the prior period. The remaining debt at Holdco, which is a holding company, is $550 million, falling due in May 2024. Cash in the holding company was $560 million at the end of the period, and the group is expecting to fully repay the Holdco debt when due. In light of the Holdco cash accretion and where leverage is today, and in view of the consistent strong operating cash generation of the company, the board intends to launch a share buyback program of up to $100 million, starting in early March 2024 over a 12-month period. $100 million, and it's on about a $5 billion market cap, so not really very big at all. I thought these results were, in constant currency terms, very good. The Nigerian naira devaluation is outside of their control. However, as you mentioned, John, it is their biggest market, and this isn't the first time it's happened. So we do have to consider that this could be an ongoing issue. It's a shame because the numbers they're putting up in constant currencies are fantastic. And then they're basically just they're basically treading water when you take into account the currency devaluations. I would hope that at some point the Nigerian market stabilizes. I don't know enough about the Nigerian money supply and banking and economy to be able to comment on that. So I think it's reasonable to assume it is just going to carry on for a while at least. What I think is a positive, assuming it does carry on, is the mobile money growth is still excellent and it's from a bigger and bigger base. So at some point, that will start kicking into a level where it's hopefully more than offsetting any losses in the currency. But the business is doing as well as it can be. It's just being let down by the markets it's operating in. In terms of the valuation, because for the year to date, it's at negative earnings, you wouldn't technically have a price to earnings. However, if you do it on historic, it's at a PE of 7.3. I think the historic's probably the right one because hopefully these issues will be temporary and they'll stop having these massive currency devaluations. Even if these issues aren't temporary, they're not going to have as many currency devaluations you'd hope as they've had this year in future years. But yeah, disappointing about the Nigerian naira, but we knew when we bought this was one of the risks. In terms of the share price as well, the shares are down 20% this month, and I think that's basically on the back of that currency devaluation. John, what are your thoughts as a fellow shareholder?
I mean, pretty similar. Good results, and then the rest is sort of outside their control. But if I address the listeners, if you do have a good knowledge of the political and economic situation in Nigeria, please do come on the show because we'd be really grateful for your insights.
Yeah. I don't know how big our Nigerian listener base is, though, so you might be slightly underwhelmed by the response we get.
Well, we'll see. And it's relevant for a company that I think we're covering next week, PZ Cousins.
Okay. Should we move on to our segment for our Danish followers now that we've covered the Nigerian followers?
Well, yeah. So it's Novo Nordisk. We have covered it, but it's been a long time. And it's, for background, it's a pharmaceutical company and leading provider of diabetic products, including insulin, but more lately, the GLP-1 diabetic injections. And the thing with them, which we'll come on to, is they've been highly effective in treating weight loss and some other conditions, including heart failure and chronic kidney disease. And this has recently led Novo Nordisk to be Europe's largest company. Anyway, on with the full year results. Full year revenue rose by 36% to 232 billion Danish kroners, ignoring the impact of exchange rates. And that was driven largely by a 42% uplift in its diabetes and obesity care segment. North America was the fastest growing region, with sales up 54% as demand for its obesity care drug, Wegovy, exceeded supply. Operating profit increased by 44% to 102.6 billion Danish kroners, reflecting top-line growth and modest price increases. Free cash flow improved from 57.4 billion Danish kroners to 68 billion, and there was a net cash position of 3.2 billion compared with a net debt position of 2.2 billion at the prior year end. In 2024, Novo expects sales growth between 18 and 26%, with operating profit set to expand faster at 21 to 29%. And the group will propose a final dividend of about 6.4 kroners a share, taking the full year total to 9.4, which is up 51.6%. And a new share buyback program of up to 20 billion kroners has been announced, and the shares were up about 3.6% in early trading. In terms of valuation, Novo Nordisk has a market cap of 2.8 trillion kroner, which is about $413 billion, and trades at 32.9 times forward earnings, compared with a 10-year average of 23.5, with a prospective dividend yield of 1.5%. I thought these results were excellent, and I think the future of GLP-1s is very exciting. Anecdotally, and I know we often put the disclaimer out that we don't have any great insight into the pharmaceutical sector, but anecdotally, the demand for the drugs, the GLP-1s, has gone through the roof, to the point where you've got NHS diabetic patients who have been switched or have been on the GLP-1 inhibitors, and then they've had to be switched off them because of the demand, well, the increased demand and hence the shortage of the drugs in the market. And interestingly, in the results, the group saw a fourfold increase of their lead GLP-1 inhibitor in the year. And I think this is partly down to the effectiveness of the drug, but then also that it's been very effective and licensed for other uses. So weight loss being massive, and also the benefits in other conditions, in some forms of heart failure and chronic kidney disease. And that's just in the NHS, where generally things have to be very effective, and particularly for the cost. And they're now recommended here. So there's a huge demand for these products. And particularly if you say that type 2 diabetes is rising, and you've also got more of some of these chronic conditions like heart failure and chronic kidney disease, the role for these GLP-1 inhibitors is absolutely massive. And the biggest player in the game is Novo Nordisk. And apparently, I hear it's got more in the pipeline that are even more effective still. So I think the sales growth, and it's got operating profit margins of above 40%. It is pretty exciting stuff for the company. I guess the difficulty, as I'm sure you're going to point out, Sam, is that it's an expensive stock. So if anything goes wrong with these GLP-1 inhibitors, and anyone else gets massively into the market too, then there is a big downside that's there. But at the moment, it is going great guns, and it's certainly really impressive. I don't know what the position is of other pharmaceutical companies coming into that GLP-1 market. And I guess that would be a reason, apart from the price, why I'd be a bit hesitant to invest. But certainly on the surface, it just looks fantastic.
I think the numbers are excellent. You can't really criticize them at all. And it's operationally, it's probably as close to a perfect quarter as you can get. I guess you could argue if they'd been able to produce more, based on what you're saying, they wouldn't have had issues selling them. So it maybe could have been even better. But it looks pretty good from where I'm sat. Now, I know you talk about the pipeline being quite excited. I know I'm very predictable here. I don't know what's likely to get all the way through final tests and approval and what isn't, however exciting it might be right now. So that's a massive question mark. Although these figures are excellent, the turnover is expected to get cut in half next year, they've said. I know anecdotally it sounds great, but these also sound, it kind of sounds like, when you think back to the lockdown and everyone was like clamoring for toilet roll and sort of Reckitt Benckiser products. This is not going to be the norm quarter after quarter. So I think to buy it when it's the most expensive company in Europe at a very above average valuation, although operationally it might be a fantastic company, I think in 3, 4, 5 years, you'll probably look back and more likely to have overpaid than underpaid.
Yeah, it is interesting on that front. And I suppose before the massive boom in this particular type of drugs, the GLP-1s, with a longer term valuation, it would have been potentially more attractive. And I know that Terry Smith is a big backer of Novo Nordisk and has been for a long time. So perhaps he had a bit more insight into some of this in the earlier stages, rather than what, as you point out, may well be the sort of a peak for the company in terms of delivering that level of growth. Also interesting to see how the fund Smith is doing as a result, because I think it is one of their larger positions.
I guess Terry's still got that magic touch then, despite having to operate with larger businesses.
Yeah, exactly. Fine. So on to, another pharma company.
Yes, so GlaxoSmithKline. So it's a company we've covered quite a few times before. They recently spun out Haleon, which we've also covered on the show. They have come out with their Q4 and full year results, and full year revenue grew by 5% to 30.3 billion, ignoring the effects of currency movements. Growth was restrained by declining sales of COVID-19 medicines. Sales across the rest of the business grew by 14% to 30.1 billion, including a 1.2 billion contribution from the newly launched Arexvy vaccine. Underlying operating profit increased by 12% to 8.8 billion, benefiting from higher margin non-COVID sales and a growing contribution from royalty income. Free cash flow of 3.4 billion was broadly unchanged from last year. Net debt decreased by 2.2 billion to 15 billion, helped by asset sales, including part of the stake in Haleon. A final dividend of 16p per share was declared, making a total of 58p for the year. And that's on a share price of £16.25. Glaxo expects this to grow to 60p in 2024. 2024 guidance points to revenue growth of 5 to 7% and 7 to 10% for underlying operating profit growth. Medium-term revenue growth expectations have been upgraded from over 5% per annum to 7% per annum. It should be noted they had 4 major product approvals last year, and further growth is expected for Shingrix for the prevention of shingles as it targets higher patient acceptance and new markets. The recently approved respiratory syncytial virus RSV vaccine, Arexvy, has made a good start following commercial launch, and although it is in quite a competitive market. The group has a strong presence in HIV treatments, which are currently about 20% of total revenues. And looking forward, the preventative treatment aptitude could fuel further growth, as it's already authorized in some areas, including the EU, which has recently been added. Cancer treatment is currently a small area for the business, although it does have several late-stage programs in the pipeline. And there is also currently issues regarding their heartburn drug, Zantac, which has some cancer links, apparently. So that's ongoing. In terms of valuation, it trades at a forward PE of 9.8, and that compares to a 10-year forward PE of 11.2. The prospective dividend yield is 4%, and that compares to a 10-year prospective yield of 6.1%. Should mention as well, in terms of the debt, what's that down to now? What did I say? Down to 15 billion on operating profits, underlying operating profits of 8.8 billion. So that's about just under double. I don't really have any issues with that. That's a pretty manageable level. I don't know how much of the debt got shifted onto
Haleon,
and that's why, but
I think quite a lot.
Yeah, Glaxo's looking quite healthy now. In terms of these results, I thought they were actually pretty good. They can't really help the fact that COVID-19 vaccines are dropping off. It's not really a surprise. So I think you can only really look at the rest of the business, which grew 14%. And I think that's a very, very healthy figure. But I mean, it's the same comments really as Novo Nordisk. I don't understand it. I'd never buy it. I mean, you can tell by my attempts to pronounce it that this is just so far from my circle of competence that there's not really any point in me spending much serious time looking. But I think in terms of what's happening with the COVID medicines, that's maybe a good example of what could be happening to Novo Nordisk at the minute with their stuff. Because a few years ago, we didn't know how long COVID was going to go on for, and it was just, very, very profitable area of the business. And then the vaccines come out quicker than maybe people actually expected. And now you've got what was a very, very good part of the business, and they've done very well from it, but it is now dropping off quite quickly. And that is having a drag on the figures. John, what are your thoughts on these results and the valuation?
They're all right. And valuation, I think, is reasonable. It feels to me, whilst I think good that they've got rid of the consumer health side of the business and that now they can be sort of a pure play pharmaceutical company. I think they've got lots of expertise, particularly when it comes to some of the vaccines. So one of the ones you mentioned was Shingrix, which again, anecdotally, it's coming in the UK. I think it's been in the US for a long time. In the UK, it's just, despite being very, very effective and much more effective than the old Zostavax vaccine, it's still an expensive drug that the NHS aren't quite using for everybody. They're using it for certain categories who can't have the other drug, basically. And then the other one you mentioned, the Arexvy, that's for a condition for very young children who can get this condition called bronchiolitis, which often not often, but sometimes they'll need to go into hospital for. And it's, again, to kind of prevent that from happening. The difficulty is, I would say the same as you, Sam, to analyze the portfolio, the pipeline, and then come to, a reasoned position on the valuation accordingly. is so difficult, and I think I wouldn't feel comfortable, competent to do that.
If you're saying that and you've got a degree in medicine,
Yeah,
I mean, I can't even pronounce this stuff. Like, genuinely,
yeah,
what is the point in me even looking at it? Because if it's too
yeah,
hard for you, I'm not going to be
yeah.
able to do it.
It feels like, if you were at a company and you had a team of analysts who understood the industry, fair enough if you were, going for this sort of thing. But otherwise, it's just the barriers to being able to understand it, I think, are very, very tricky. Otherwise, I suppose you're being quite speculative. I think one option, if you were going to invest in pharmaceuticals, would be more a basket type approach, or some sort of fund that has that theme. I think that would probably be the best way forward. And then, in that sense, if you believe in the industry, it's more difficult to go wrong, I guess.
I just prefer simple businesses. It's like Diageo, really
Yeah.
easy to work out what they do and how they make their money.
Yeah, no, and I do, agree with you, and I guess it's that sort of Peter Lynch would, make exactly that point. Sort of businesses, and ones that are, easy to understand too.
Should we move on to a business that's easy to understand?
Yes, no, absolutely. So into the industry of soft drinks, which we do quite like on the show. So AG Barr, they had their full year trading statement out, with the group expecting full year revenue to come in at around £400 million, up roughly 7.6% on a like-for-like basis. And that's as a result of a broad mix of brands helping delivering a strong second half performance. Underlying pre-tax profits are expected to rise to 13.8%, which is about 49.5 million, which is slightly ahead of market expectations. Cost inflation has eased from the heights of the prior year, and coupled with ongoing investment plans aimed at improving the supply chains and margins, AG Barr has confidence in its long-term growth strategy heading into the new year. Succession plans at the top have been announced, with Ewan Sutherland named as the incoming chief executive. He's previously been at Saga, Superdry, and the Co-op Group. I'm not sure whether that's a good thing. Perhaps he was at some of those companies in the better days, but I don't think any of them are doing very well now. He'll replace Roger White on the 1st of May, who has stood down from the helm after more than 20 years. The shares were up 1.1% in early trading. In terms of valuation, AG Barr has a market cap of £595 million and trades 16 times forward earnings, compared with a 10-year average of 19.2, and has a prospective dividend yield of 2.8%. I thought these results were pretty decent, and when we're comparing it to some of the other consumer goods companies, it's not the best, but it's certainly holding its own up there. And it was encouraging to see some of the newly acquired businesses. So Boost Drinks, seeing sales jump 26% year on year, and excluding this, like-for-like sales growth in the high single digits. And what they've also done with some of their existing core brands, so Rubicon launching the energy drink, and also Iron Brew having the Power Brew drinks, again, sort of on that energy drink theme, which is a growth area of the market. And then there's also Funkin' Cocktails, which is the number one of ready-made cocktails in the UK. In terms of, its valuation, I think that's pretty reasonable at 16 times. I guess there are other companies at the moment in the UK market, and you've got something like Diageo, which is at 18 times forward earnings. And I appreciate that's on some disappointing news in some of its regions. On its own, I think it's decent and it's attractive, and it could certainly make the investment case for it there. But there are quite a few companies, and I put Unilever in the mix as well, that aren't that expensive compared with their historic averages, that I'd probably pick before AG Barr. And that would be my only issue with it. But that's obviously not AG Barr's fault.
I think these results are really good. I mean, it's anecdotal, but every time you get on a train, you do seem to, or every time you get on a train on a Saturday, which is pretty rare, you do see the Funkin' everywhere. You can tell where a hen party's been before you. So, yeah, it does look like the brands are doing pretty well. You've got Rubicon coming out with an energy drink as well. I don't know. I think these results are really good. They're definitely better than the Britvip results we covered most recently. So it's outperforming its most direct competitor. It's slightly more expensive than Britvic at the minute, but it's putting up better results. Whereas previously, it's been the other way around. It's been a bit. I think there's time in the past we've covered it where it's putting up worse results than Britvic, and it's more expensive. But at the minute, I think it probably looks like better value than Britvic. My main concern with this set of results isn't, well, it's not the results at all. But like you say, I think the new CEO, it doesn't look like a particularly inspiring choice.
Yeah, it's really questionable. I mean, I don't know. They obviously must know much more than we do about it. But with those, again, I can't say what his record was there. It could be before Superdry went down and Saga pretty much collapsed, you know. But yeah, and to be fair, I haven't looked at how the co-op did.
No.
But
I don't know. I think, you know, in terms of like actually attracting a new CEO, and maybe he'll prove us wrong in fairness to him, but AG Barr, you'd think it'd be quite an exciting company because it's the number 2 in terms of the listed stocks. I think it's made some quite smart acquisitions in the last few years, especially the Funkin acquisition. And it's got some decent brands and it is putting up good results. And it is, you know, I know we always sit here and say, well, you know, there's companies we like more, but it is a good little performer. And I don't think it's that unreasonably priced. The issue is there are other ones at a better price. But I think if you were to do a direct comparison to Britvic, which is the fairest comparison to do, I think at the minute, I mean, I'd like to see another quarter or two like this or another half or two like this and see if Britvic's issues continue. But it might be getting to a point where it's maybe, you know, a better investment than Britvic, which is probably the first time we've sat and said this on the show. But I don't think you can really knock these results. I think they're doing a good job.
And interestingly, so the share price of AG Barr over 10 years, it's down 13%. 5 years, it's down nearly 30%. And 2 years, it's broadly even. It's up about 2%. So I think we've broadly been covering it for the last 2 or 3 years. And these figures are, you know, like you say, are impressive. And actually, I don't think, just thinking
it's only just started doing this though in like the last 12 months. If you go and look at the last 5 years financials, you've got 4 years that are basically flat, and then it jumps last year. So it does need to get a bit of consistency.
Yeah. Well, anyway, it's certainly gone up in my estimations.
Should we move on to a PayPal that's not been going up in your estimations?
Well, I don't know. I know it's one you like, Sam. So just out with the results.
Yep. So PayPal, which I'm sure doesn't need an introduction, but they've come out with their Q4 results, and total payments volumes were up 13% to 409.8 billion, ignoring exchange rate movements. This drove 9% revenue growth to 8 billion ahead of previous guidance. Underlying operating profit rose by 11% to 1.9 billion, benefiting from the increased revenue and disciplined control of the cost base. Underlying free cash flow fell by 46%, reflecting the impact of higher taxes and the timing of certain operational receipts and payments. Net cash at the year end was $4.4 billion, and all these figures are in dollars. The group completed $5 billion of share buybacks in 2023 and expects to at least equal this in 2024. And that's on a market cap of about $63 billion. I think it's 63 billion. So these buybacks are chunky. They're like 8% or something like that. Yeah, 63.5 billion. 5 billion of share buybacks a year. Revenue is expected to grow 7% in the first quarter of 2024, ignoring the impact of exchange rates. And for the full year, underlying earnings per share are expected to be broadly flat compared to $5.10 for 2023. And the shares were down 11% following the announcement. In terms of valuation, the business trades at a forward P of 10.2, and that compares to a 10-year average of 29.5. It doesn't pay a dividend, but as mentioned, the buybacks are very aggressive. I think these are a good set of results. It's really, really cheap. I've topped up following these results. I don't understand why the shares fell 11% following the results, because apparently the market was disappointed because the earnings are expected to be flat next year, but you're getting $5.10 of earnings on a business that you're buying for $60. So it's I don't know what people are expecting. It's kind of like, well, why do you think it's so cheap? It's not going to be growing 20% a year, but it's now priced like a tobacco stock. And I just find it really, and the growth figures are still good. It's still growing nicely. I mean, even the growth figures are actually quite like a tobacco stock, actually. But I find it really odd. And I know these results aren't like amazing growth figures, but I just don't understand what people actually expected. But
Mm.
I mean, I thought earnings flat next year at $5.10. They're going to be doing another 5 billion of buybacks. I'm pretty happy with that. I don't know what, like I say, I don't know what people are expecting from it, but I thought for the price it trades at, and I appreciate that I've only bought it recently, and if I'd bought it at $300 a share instead of 70 or 60, I might feel a bit differently. But for the price it trades at, I think these are pretty good results, and I don't know what more you can be expecting from it. What about you, John, as a neutral?
Yeah, I would say the results, I would agree with you, are half decent. Well, decent. It's difficult to see why the market has reacted as it has. I think my main concern is just Apple and Google coming into the market. And I know anecdotally, so this is kind of, I guess, Peter Lynch again, I'm using Apple Pay for almost everything. And I do still have a PayPal account, which, how often do I use it? Barely ever. And surely at some point, whilst I appreciate payment volumes are up 13%, is that not going to, whilst growth, I know, it's slowing, going to, completely into reverse?
I don't know. Because it's like you say, you use it for everything and then it's still grown 13%. I just think,
I know.
I think a lot of the market share that Google and Apple are taking, and they are taking market share, but I think a lot of it's probably from like Visa and MasterCard instead. Because a lot of it is the kind of like everyday stuff where you wouldn't, I will use Google Pay if I get a meal deal at Sainsbury's. Now, I've never
Yeah.
bought a meal deal at Sainsbury's with PayPal, but I
Yeah.
have done it on debit and credit cards.
Yeah.
If I'm online, I primarily for my current account use a Chase account, and because it's a debit card and you get the 1% cash back. I mean, I know I say this every 3 months when we cover PayPal, but you get less protection from a debit card than a credit card. And prior to setting up the Chase account for the 1% cashback, I used to use a credit card for everything. So it was fine. I was using PayPal less. Switching to Chase, actually, I link my PayPal to it because I get the PayPal protection on top of the debit card. So I've just got much more protection. So for anything I'm buying online, my default is the PayPal. If I get the option to add it, I do, because it allows me to buy with my debit card and get the 1% cash back. I know that's a fairly unusual scenario, but if you log into Chase, you will see as soon as you log into it, link your PayPal account. So they're obviously pushing that, but I think Apple and Google are, they are taking market share, but I just think these numbers suggest that they're not taking it from PayPal. They're taking it from Visa and MasterCard, I think.
Okay, interesting. Because I was going to say, I take your point with how you're using it with your Chase account. I would wonder how many other people would do that, or how many would either just pay with a debit card and not worry about the protection they'd be getting with that, or alternatively have a credit card and use that on Google or Google and Apple Pay.
But then it's just, I know we're talking about that anecdotally, but these numbers don't back up the story that everyone's spinning, that PayPal's dead because everyone's using Apple and Google. We've been covering this for probably like 12, 18 months now, and it's still putting up decent growth figures of sort of 10 to 15% a year. This isn't a company that, I mean, it's not even declining. It's still growing quite a healthy amount. And it's 10 to 15%. I mean, it's 13% this quarter, but when you look at the size of PayPal, this is actually a really impressive number.
Yeah. Interesting. Do you know any big investors who are putting the bull case for PayPal? Just out of curiosity.
Besides me.
Well, yeah, besides Sam Ball, yeah.
There's no big funds that I recognise in the top holdings, but I don't recognise that many funds, to be honest. I just know a handful of the most famous ones.
Okay. And where do you see it going, Sam, then? Because obviously you've bought shares yourself.
I do. I know I said it jokingly, but I just think it's mispriced. I view it almost like a tobacco stock. If it can grow 5-10% a year and buy 8 to 10% of the shares back every year, I mean, I don't really need it to do much else. It's like I was saying with the share price drop, when it's already so cheap, I just don't know what people are expecting it to do, which is why I topped up on it following that drop. It might be that people are selling it in anticipation of what's going to happen and it's going to start declining pretty soon. But even in the guidance, which people are unhappy about, the guidance is still all right as well. So they're expecting revenue to grow 7% next quarter. So it's still pretty healthy. And I don't have an issue with the earnings per share staying flat. Any growth I get from it is going to be a bonus. It's really for the buybacks. And I just think I think it's mispriced. I think we'll see an earnings revaluation. So I think to get a business, the quality of PayPal at an earnings multiple of 10, when it's growing 13% a year and you're getting basically an 8% return on buybacks. If you look at other US companies of similar quality, this is very much an anomaly. Yeah. And I think at some point it's going to get re-rated. I'd probably sell it at that point, but I don't see it as something I don't see it as something I'd be holding in 10, 20 years, unless the price just stayed the same. But it's the same with a tobacco company. If I bought a tobacco company, it went up 2 or 3x, I'd probably get rid of it because
sure.
I'm not expecting it to do a huge amount. I just think it's mispriced. I think, if you go and get any similar quality US company, it's priced like it's going bust. And I don't think it is.
Yeah. No, fair enough. Okay. Is it a silly question then to ask you what your company of the week would be?
Well, it's tough because we've got Airtel in, which I like a lot. And I've got Diageo as well. I think you can make a very, very strong argument for any of Diageo, Airtel Africa, and PayPal on valuation. I'd probably go with Airtel Africa just because I think the reasons the issues it's having are not of, the business operationally that was a fantastic quarter. It's just unfortunate it's operating in Nigeria. So, but I think that's priced in, and I do think I think with the mobile, I know we talked about it before, but with the mobile money, and hopefully if Nigeria can just sort its currency out as well, it's very, very cheap. But yeah, I do like Diageo and PayPal a lot as well. Least favorite would be any of Glaxo and Novo Nordisk, probably Novo Nordisk, just because it seems more expensive. So I've got two businesses I don't understand equally, and one of them costs more than the other. I'll probably just like the pricier one more. But what about you?
I mean, I think the standout performer is Novo Nordisk in terms of the results, but in terms of company and sleeping at night, I think Diageo would be the one, and particularly with the valuation at the moment. Airtel Africa, close second. And then I do like it. I do think, certainly growing on me, AG Barr. PayPal, you're making an interesting case to me the more I hear it, Sam.
It's just a value. I just think it's value.
I think it's obviously not a company that you would traditionally associate with it as a value play.
It's you go back 3 years, it was 6 times more expensive in terms of the share price.
Yeah.
It was trading at a PE of 50. And everyone on Twitter, I know you don't use Twitter, but everyone on Twitter was telling you why it was cheap.
Yeah.
No one talks about it anymore. It's really weird.
And when did it actually peak? So it peaks, sort of late, mid 2021, I think.
Yeah, it was a COVID stock, but it's had quite the drop though. It's just ridiculous. It's peaked at about $300, and but then it's just gone so far. I mean, it was overpriced, but it seems to have just gone so far the other way. But I mean, I've never held it before. I think I started buying it at like $70, and then I've topped up at 60. So
yeah, fair enough. Okay, well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.